Well, this is still the most hated V-shaped rally. Of course, has a lot to do with when stocks fell in a waterfall decline into April. Nobody likes to be sitting on stocks, so a lot of folks liquidated at the lows. But we know that whenever the VIX is above 60 and falls below 30, you've made a decisive low.
Well, I think we have been climbing a wall of worry. I mean, a lot of people expected tariffs and wars and the controversy between the Fed and the president to really shake markets up. And of course, there has been some volatility. But these are the kinds of bull markets that I think are the most durable. When the market climbs through all of that controversy, it's really signaling something.
As we enter the second half of 2025, markets are defying expectations. The S&P 500 is pushing record highs. The Nasdaq 100 just wrapped its best quarter since mid-2020, and growth sectors like tech are once again leading the charge. Year to date, the Ark Innovation ETF is up nearly 24%, and volatility, as measured by the VIX, has collapsed from recent peaks. Meanwhile, the crypto market is showing strong bullish momentum this week, with Bitcoin holding steady above key support levels and signaling growing confidence from both institutional and retail investors. Ethereum is gaining strength as anticipation builds around upcoming upgrades, while capital continues to flow into altcoins tied to AI, real-world assets, and DeFi infrastructure. With macro conditions tilting in favor of risk-on assets and markets increasingly pricing in potential rate cuts, digital assets are catching a powerful bid. On-chain activity is rising, exchange balances are dropping, and long-term holders are staying firm, suggesting that supply is tightening just as demand picks up. Yet despite these strong numbers, investor sentiment remains skeptical. According to the latest AAII survey, bearish sentiment is still elevated relative to historical norms, which raises a critical question: is this rally sustainable, or just another bear market trap? To help us understand what's really driving this recovery, we turn to two of the most closely watched names in the market, Fundstrat's Tom Lee and Ark Invest's Cathie Wood. In a recent interview with CNBC, Tom Lee argues that we've already made a decisive bottom. With the VIX dropping from above 60 to below 30, he believes we're in the early stages of a classic V-shaped recovery, one that's often missed by investors who sold at the lows. Cathie Wood, on the other hand, sees something deeper beneath the surface. She describes a market climbing a wall of worry, navigating geopolitical tensions, trade disruptions, and central bank uncertainty. To her, the durability of this bull market lies in the resilience it has shown in the face of fear and volatility. In this video, we'll break down what each of these analysts is seeing in the data, from volatility trends to sector rotation, Fed policy signals, and where institutional capital is flowing. We'll also unpack their outlooks and examine what this shift in market structure could mean for crypto, from macro risk appetite to institutional inflows, and what signals you should be watching in the second half of 2025. If you find value in data-driven, expert-backed market insights, don't forget to like this video, subscribe to the channel, and hit the bell so you never miss a future update. Thanks, and enjoy the video.
Well, I think we have been climbing a wall of worry. I mean, a lot of people expected tariffs and wars and the controversy between the Fed and the president to really shake markets up. And of course, there has been some volatility. But these are the kinds of bull markets that I think are the most durable. When the market climbs through all of that controversy, it's really signaling something. And I think the things that it is signaling are interest rates probably are coming down. And I think what many people are not focused on in the inflation statistics are the housing numbers, and they get in there with a long lag. We think that the shift or the concentration towards just a very few stocks, which was a very unhealthy bull market, that is changing and the market is broadening out. And I think deregulation is probably one of the most important things that this administration is doing to unleash animal spirits. Well, I think we've been pretty consistent on this idea of we've been through a rolling recession. If you look at housing, which is actually having a little bit of a relapse today, housing plummeted in 2022 when interest rates shot up, and it has not recovered. Manufacturing has not recovered. And so we do believe that they will recover as interest rates come down, deregulation takes hold, some certainty about tax cuts and so forth occur, including immediate expensing, perhaps, of capital goods, which would be very positive. So we think we'll move from a rolling recession into a recovery. But what happens early in a recovery, if you will allow me to call this that. I know many people think we never went into any kind of slump, but we have sector by sector. What typically happens when you come out of a recovery is productivity kicks in because companies have been very conservative and especially amid all of the uncertainties. So productivity kicks in and actually drives inflation down much lower than anybody anticipates. And I think that's going to happen this time as well. I think what happened, and this could be considered a conspiracy theory, but, with Trump and Musk so close at one point, and with China, President Trump's primary focal point when it came to trade negotiations at the end of the day, Tesla's plant in Shanghai became a leverage point. So I think they've separated naturally. Now, I think it went a little overboard in terms of the drama. And I think the same is true today. I do think that Elon Musk is getting back to business, and he does want to transform transportation, continue to transform space exploration, really address some incredibly difficult health issues with Neuralink. And introduce productivity the likes we have never seen with humanoid robots. So I think at the end of the day, he'll become very focused on those very difficult problems, and this too shall pass. Well, I guess in terms of dependence on government, SpaceX, I believe, has $22 billion in government contracts, and really has catapulted the U.S. into the lead when it comes to space exploration. I don't think the president that formed the Space Force wants to change that. And in terms of transportation, of course, we've got a patchwork quilt of 50 states from a regulatory point of view that have to bless autonomous travel. We were thinking and still think that will move up to the federal level. So maybe that's in question very short term, but we think it makes sense for the United States if we want to be number one in autonomous travel. FDA is another consideration when it comes to Neuralink. I think what's happening is pretty miraculous if you've been following Neuralink. And the FDA, if anything, I think we've been most surprised by the deregulation that is taking place within healthcare and the desire of the leaders in healthcare to really either cure disease, get rid of chronic conditions. So, Elon Musk is contributing to that cause as well. So, I'm sure there's political tit for tat. That's how these things work out. But Elon Musk is working on the largest AI projects in the world, the largest projects in the world. And I don't think longer term he wants to be thrown off really transforming the world.
Cathie Wood paints a picture of a market that's misunderstood by many and possibly undervalued by most. Her first key observation is that we are climbing what she calls a wall of worry. Despite fears surrounding tariffs, Fed uncertainty, and political tension, equity markets continue to rise, a pattern that historically signals the start of resilient bull markets, not temporary rallies. Backing this up, the VIX Volatility Index has declined sharply from its 2024 highs, recently stabilizing under 18 levels that suggest investors are growing more confident, even if the headlines still breed caution. This is important for crypto as well, since lower volatility in equities often translates into greater institutional appetite for risk assets, including Bitcoin and Ethereum. That matters deeply for crypto. As equity volatility compresses and risk-on sentiment returns, institutional capital often rotates into high-beta assets, and crypto sits at the outer edge of that spectrum. We're already seeing signs of this. Bitcoin ETF inflows have resumed after a brief cooldown in Q2, with over $2.5 billion in net inflows in June alone, led by BlackRock and Fidelity. That kind of participation signals renewed confidence, not just in Bitcoin's long-term thesis, but in the macro environment supporting risk assets overall. Cathie also notes a structural shift underway in the market, a broadening out beyond the megacaps. When capital begins to flow into small caps and innovation plays, it's often a leading indicator of rising liquidity and a higher tolerance for volatility. In the crypto space, this dynamic has historically preceded bull runs across Ethereum, altcoins, and Web3 infrastructure tokens. In other words, when traditional investors begin looking down the risk curve, crypto starts moving up the leaderboard. But Cathie isn't the only one spotting signals beneath the surface. Tom Lee sees something similar unfolding, backed by decades of data and a sharp read on investor psychology.
Well, this is still the most hated V-shaped rally. And it, of course, has a lot to do with when stocks fell in a waterfall decline into April. Nobody likes to be sitting on stocks, so a lot of folks liquidated at the lows. But we know that whenever the VIX is above 60 and falls below 30, you've made a decisive low. And now visibility is better. Tariffs aren't as bad as we expected, and the inflation impact actually has been very muted, and actually outside of tariffs, underlying inflation is actually much lower than people expected. And I think the Fed is, even if they're holding now, the bond market doesn't believe it. If you look at the 2-year, they think the Fed's 2 cuts behind. The 10-year is now down to 4.2, which means the Fed can be more dovish in the next 12 months, and that's a tailwind for stocks.
Can you explain how we have this big, beautiful bill, which people are saying $3.3 trillion added to our deficits and everything else, and yet you're looking at the 10-year coming down?
Yes. It shows you that markets don't view the U.S.'s debt sustainability purely as its budget. Because I think there's a lot of hidden value on the U.S. balance sheet, from natural resources to buildings they own to the value of gold is undervalued. And in a way, when people say the U.S. can't find buyers of its treasuries, it's actually finding it. It's going to be stablecoins. Stablecoins are going to replace any foreign holder of treasuries because...
Is that a temporary situation? Like once you do that to a certain level, then sort of living in its own universe?
True. It depends. Stablecoins are $250 billion today. The total circulating supply of dollars is in the nearly 10 trillion. So stablecoins can grow. A lot of stablecoins transactions happen outside the U.S. So dollar dominance could actually be much higher in a stablecoin world. But the main thing is it's at 4.2% the 10-year. I think the bond vigilantes are essentially correct. The U.S. should not be running a deficit like this. But for whatever reason, we're not at the levels yet where debt sustainability is a question.
Where you still look at your year-end target is at 6,600 still? So that's up about 8% from where we closed on Friday?
Yeah, I think that the reason people don't think there's more upside, I think there's upside to 6,600 because the PE of the market can go up a lot. We already had 5 shocks. We had the COVID shock, the supply chain shock, the inflation shock, the Fed fastest hikes in history, and then we had the tariff shock. So 5 shocks in 5 years.
5 years, yeah.
And earnings kept growing. If this was like a stock, we'd say, look, if you tried to kill it 5 times and it still grew earnings, we would put a much higher multiple on it.
Tom Lee describes the current market environment as the most hated V-shaped rally, a classic sign that sentiment and positioning are still misaligned with price action. After a waterfall decline earlier in the year, many investors capitulated near the lows. But Lee points out that when the VIX, volatility index, drops from above 60 to below 30, it has historically marked a decisive bottom. As of today, the VIX is hovering near 16.5, well below crisis levels, suggesting investors are underestimating the strength of the rebound. This type of sharp recovery, despite skepticism, often lays the groundwork for prolonged risk-on cycles. As capital rotates back into risk assets, it's not just Bitcoin drawing attention. Ethereum and stablecoins are emerging as critical infrastructure in the next phase of crypto adoption. And few analysts are better positioned to speak on this shift than Tom Lee, who just announced his new role as chairman of a major Ethereum-focused treasury initiative backed by leading names in both traditional finance and crypto. In this next segment, Tom explains why 2025 is shaping up to be a turning point for Ethereum. From the explosive growth of stablecoins, already the 12th largest holder of U.S. treasuries, to the increasing convergence between financial institutions and blockchain, Lee makes the case that Ethereum's role as a base layer for global finance is becoming undeniable. And as the U.S. doubles down on dollar-backed digital assets, Ethereum may be the very backbone that secures dollar dominance in the digital era.
I'm still a big fan of Bitcoin because I think it is, digital gold. But what we've seen in the last, really in 2025, is the financial services industry and crypto are converging. And it really started with stablecoins, which is the ChatGPT of crypto, right? Because it's viral adoption by consumers, businesses, banks, and now even Visa. Underneath the stablecoin industry is Ethereum. That is really like the backbone and architecture of stablecoins. So it's important to create a project that essentially accumulates Ethereum to essentially protect and have some influence on the network. So that's why we're creating this treasury vehicle to buy Ethereum. The more Ethereum that's accumulated, the more secure the network is. And I think it's also sort of the architecture that future banks will have. When Goldman issues a stablecoin and JP Morgan doing it on Ethereum, as a layer one blockchain, they're going to want to secure it by staking Ethereum. So we're trying to get in front of that by creating a treasury vehicle.
And just so I understand, it's safer if you own more of it. Explain why that would be.
Well, Ethereum is a proof of stake network.
Right.
So unlike Bitcoin, which is proof of work and miners do all the work for you, and that's why you have decentralized trust, in Ethereum it's important for these entities to essentially validate transactions. So by becoming a staking entity, you're sort of securing the fidelity of stablecoins. So you don't want a stablecoin like USDC or USDT to be on a blockchain that's outside the purview of the U.S. And so I think Ethereum is a high quality, the second largest blockchain network, and it's over 51% of stablecoins, and
right.
30% of all fees on Ethereum are actually stablecoin revenue.
You're basically saying that this is the new Bitcoin. You're getting in at a very early stage.
Correct. That's right. Because let's say stablecoins, which is $250 billion today, gets to Treasury Secretary Bessent's reasonable $2 trillion. That's a 10 times increase in size. By the way, already stablecoins are the 12th largest holder of treasuries. They'll become the number one holder by then. U.S. dollar dominance is 27% in GDP terms. It's 57% of central bank reserves. It's 80% of financial trading transactions. It's 100% of stablecoin denomination. So by getting to $2 trillion, you're ensuring dollar dominance. This is very good for the U.S., but $2 trillion of stablecoins is a lot of network fees for Ethereum.
So BitMine Immersion, what you're doing is a $250 million private placement, which is all going to be put into
Yes,
Ether?
That's right. We created a carefully curated list of investors to bet on this. If you look at the press release, it is the blue chip, both in the financial world and in the crypto world. We have
Founders Fund, Kraken, Galaxy Digital.
Yep, Pantera. Yeah, so these are in the crypto world, and these are like sort of the blue chip crypto entities. And of course, Founders Fund is legendary in the traditional financial world.
And how do you measure this? It's just based on exactly how Ethereum is trading?
Well, yeah, the strategy of the company is going to be based on how much Ethereum is held per share.
Okay.
And as of today, it's $4. And the company, as we explained in the press release, can increase its holdings of ETH by getting yield from Ethereum, doing financing transactions at a premium to their holdings, and of course, if Ethereum goes up. So I think there's three ways that value per ETH actually grows.
As we step into the second half of 2025, one thing is becoming increasingly clear. Despite macro uncertainty, political noise, and pockets of skepticism, markets are flashing signals of strength, and the implications for crypto are profound. Cathie Wood sees a market climbing a wall of worry, powered not by speculation, but by resilience. Inflation pressures are easing, long-lagging data like shelter CPI is set to normalize, and falling interest rates could soon release pent-up demand in sectors like housing and manufacturing. But more importantly, she points to productivity and deregulation as the hidden forces capable of driving sustained growth. In this framework, crypto isn't just a speculative asset. It's a core piece of the innovation engine she believes will define the next economic cycle. Tom Lee, meanwhile, reminds us that market psychology often lags price action. The V-shaped rally we're witnessing in equities, backed by a steep decline in volatility, tells us a bottom may already be in. And history shows that when the VIX falls from crisis levels into complacency, it often precedes multi-quarter rallies across all risk assets, including crypto. This kind of macro recovery is exactly the environment in which Bitcoin, Ethereum, and digital assets tend to outperform, as liquidity returns and institutional allocations expand. But perhaps the most forward-looking insight came from Tom's latest Ethereum initiative. As stablecoins surge in adoption, now holding hundreds of billions in assets and expected to top $2 trillion, they are becoming the connective tissue between traditional finance and blockchain. Ethereum, which secures over 51% of stablecoin volume and accounts for nearly a third of all blockchain fee revenue, is rapidly solidifying its position as the settlement layer for the next generation of digital finance. This isn't just about market cycles, it's about foundational shifts in financial infrastructure. For investors paying attention, the writing is on the wall. The convergence between crypto and traditional finance is no longer a theory, it's happening in real time. With Bitcoin holding strong, Ethereum gaining institutional utility, and stablecoins emerging as a geopolitical tool to protect dollar dominance, the digital asset space is positioning itself at the center of the next phase of global economic transformation. The volatility may not be over, but the signal beneath the noise is growing louder. As the macro backdrop shifts from defensive to opportunistic, the crypto market may not just follow, it could lead. And let us know in the comments. Do you agree with Cathie and Tom, or are there risks the market is still ignoring? If you found this analysis helpful, make sure to subscribe, like the video. We'd love to hear your take. Thanks for watching.